everyone. I think we are ready. The technical issues have been sorted out. So I'm very happy to share with you the good news that the Indian economy in the first quarter defied expectations of a modest growth of around 6.5 to 7%, which was broadly the consensus range. In terms of constant price-based growth, it actually crossed 7.5% to register a number of 7.8% year-on-year in the first quarter of FY26. In comparison to several other countries which have already reported the data for the April to June quarter, India's numbers are far higher than every other country's first quarter, April to June quarter GDP number, which is what you see on the right side. Next slide. Thank you. The growth was fairly broad-based. Of course, April to June quarter isn't particularly known for agricultural GDP growth, hence you see that number at 3.7%. But in terms of manufacturing growth, which we will talk about a bit later, around 7.7%, and the services sector, which we have been seeing in the fairly robust PMI services index readings in the last several months, the growth rates, annual growth rates in services and manufacturing have registered a very good number. In terms of the overall mix of the GDP growth between consumption, investment, and exports minus imports, consumption 60.3%, gross fixed capital formation is around 30.4%, exports were nearly 21%, and imports were 22.8%. So we have a fairly well-distributed growth composition in terms of the different shares of GDP by expenditure, which is in line with the long-term averages. One more thing that some of you might be pointing out, which is not here in this slide, is the fact that the net indirect taxes have contributed close to 3.2 lakh crores in the GDA to match with the GDP by expenditure figures. If you look at it, basically, between the first quarter of last year, which was 3.55 lakh crores, and the first quarter of this year, 3.96 lakh crores is total indirect taxes, which is 11.5% increase. Subsidies, which were 90,000 crores in the first quarter of last year, is down to 83,554 crores in the first quarter of this financial year, which is a reduction of 7.3%. So if you put the two together, you have nearly 18% increase in the net indirect taxes in the first quarter of this financial year compared to last year, which is what explains that large number. I'm sure this will sort of wash over in the coming quarters, so that this slightly larger contribution from net indirect taxes will not necessarily sustain in the coming quarters. Next slide. If you look at the next quarter, the current quarter, which is ongoing with September month to go, you can see that the agricultural activity in the wake of a fairly robust monsoon is going to be very high, and the Kharif crop sowing is much higher than the average and the historical ranges as well. Rural consumption has held up very well. In fact, we will even argue later that urban consumption too hasn't been as weak because we may be looking at the wrong indicators. But nonetheless, rural consumption has held up because real wages in agriculture for both men and women have risen very sharply based on data from Labour Bureau and the Ministry of Statistics on CPI rural, inflated by CPI rural. So that also helps. So a very strong agricultural sowing season, good monsoon, good storage level in reservoirs, and rising agricultural wages also augur well for the next quarter, the July to September quarter GDP numbers, and the GDA contribution from agriculture therefore can be expected to be higher. Next slide. We are trying to show you here, in the light of all the questions that we may have about the economy as a result of the tariff-related uncertainties, we want to show you how the various activity levels are stacking up now compared to the pre-COVID average on the right side, and also for the FY24-25 period. So these are year-on-year growth numbers. E-way bill generation, 25.8% growth in July and 20.5% in the first quarter. On the right side, you can see the comparison pre-COVID and last financial year. Same thing for non-food bank credit growth, which is 13.2%. While it is lower than the 14.8% of last year, we should also appreciate the fact that commercial paper issuance by companies and the private placement of bonds and good fundraising activity through IPOs makes up the overall resource mobilization, apart from the fact that companies are sitting on fairly large accumulated earnings from the last 15 years of growth in corporate profits, means that resources are ample for capital formation. Electricity consumption has been on the lower side compared to last year and the pre-COVID averages. Petrol and diesel consumption, and as we are explaining here, petrol and diesel consumption expanded at a slightly higher pace in the first quarter compared to the July month or compared to the previous fourth quarter of the last financial year. Growth in electricity consumption has slowed, but it's also suffering from the high base effect from last year's heat wave condition, which prompted a huge use of air conditioners. And if you move on to the next slide, if you look at the indicators of industrial activity, the 8 core industries production, which is on the top line, year-on-year growth. Only the PMI numbers are absolute numbers, not growth rates. And we also include net real sales of listed manufacturing companies, because there will be questions about the fact that GDP manufacturing has done very well, whereas industrial production growth has been somewhat on the tepid side. But because GDP manufacturing is calculated using the gross value addition of listed manufacturing entities, which has done quite well. And service sector activity are very much above par with respect to both pre-COVID and the last financial year. Port traffic annual growth rates are in line with long-term averages. In fact, the first quarter number was very good at 5.6% in general. And if you look at the domestic cargo growth, again in line with the pre-COVID averages, railway freight traffic, and so on. So hotel occupancy growth also has been doing quite well in the last 2 quarters. So overall, I think the economic activity indicator that we have seen so far do not indicate any material slowdown of the momentum which we saw last year, and it is still continuing, which is what is reflected in the first quarter GDP numbers. Next slide. In terms of robust growth in trade and construction activity, non-oil, non-gems and jewelry exports were pretty strong at 12.7%, much higher than the previous periods, both pre-COVID and 24-25. Import numbers are also been robust. Net inflow of, in terms of services sector, which is a services sector trade surplus numbers, growth rate is 6.6%, but the first quarter now in July, but the first quarter growth rate was 20.7%, maintaining the pace set in the previous financial year, last quarter of 24.9%. In terms of steel consumption, 13.8% in July, following the first quarter 8.2%, and cement production much pretty vigorous in July and in the first quarter compared to the last quarter of last year, and infra and construction goods growing also nearly at 12%. Again, this is a fairly robust set of growth indicators in different measures of construction activity. Next slide. In terms of urban demand, if you look at the UPI transactions, volume growth is about 34.9%, maintaining the very high growth rate we have seen in general. FMCG volume sales in urban India, 6% growth. Last year was 5.3. Passenger vehicle sales has been on the slower side. Some of it could be attributed to the waiting that some people have entered into for anticipating the GST numbers. And also domestic air passenger traffic growth in the first quarter was 5.3% compared to 5.6%, which is in the first quarter of the last financial year. Next slide. Rural demand indicators, as we have shown earlier in terms of rural wage growth, FMCG volume sales 8.4% in the first quarter, which is very much higher than 6.2 of last year. Two-wheeler vehicle sales in rural India has been much more vigorous than in urban India at 8.7%. And in July, and three-wheeler vehicle sales, obviously, it is pretty high at 17.5%, and the tractor sales at 8% compared to 8.7%. Continuing from the momentum that we have seen from the first quarter of the calendar year, January to March, 20.7% and 8.7% in the first quarter of the current financial year. Next slide. Here, this may be too much of data, but you can actually download it yourself if you wish to from the UPI website, from the NPCI website, where they have started giving us data on very high levels of merchant category classifications. If you look at the growth rates in groceries, fast food, eating places and restaurants, telecommunication services, etc., the annualized growth rate, because we have compared the data from June 2024 to July 2025, you look at very high growth rates, excepting in a few areas which we have highlighted. Everything else we have seen witnessed very high growth rates, more than 20% in general, in several categories. So this kind of tells us that we need to be looking at digital sales and digital transactions of services to get a better sense of what is happening to private consumption, rather than looking at conventional survey-based indicators. So it is good that NPCI has started releasing this data, and we will be sharing this with you. So this kind of should allay concerns regarding urban consumption growth as well. Next slide. Now, if you look at the capital formation, moving away from consumption and trade and other output-related indicators, overall, the central government's capital expenditure showed a very high growth rate in the first quarter. And actually, last year's first quarter had a very low base due to the election-related slowdown in capex spending on the part of the union government. IIP capital goods 5% compared to 6.1 last year, and the first quarter was 9.8%. Capital goods imports quarterly data 2.8%, following up on the 2.2% growth in the final quarter of last fiscal year. And RBI's capacity utilization measures are pretty high, and the CMI data on new private sector investment intentions was very robust in the first quarter of the current financial year. So overall, investment activity is keeping up quite well, which you saw in the gross fixed capital formation share of GDP at 30.4% in the first quarter data. Next slide. In terms of inflation numbers, which will also contributed to the fact that nominal GDP of 8.8% translated into real GDP growth of 7.8%. Inflation both at the retail level and in the wholesale level have been on the lower side in general in the course of the current calendar year, which is what you see in the data on your screens. And EPFO, net additions, year-on-year growth rate in the first quarter was 65%, very impressive growth rate. And the In terms of the Naukri jobs peak index, it is 6.8% growth in July, which is a very good growth rate compared to last year's negative or contraction of 3.7%. So overall, again, inflationary pressures are low, and the fact that there is a direct tax cut, significant cut announced in the budget, and the possibilities of a lower GST coming up in the coming month, along with the fact that the overall inflation rate is already been low, means that disposable income in the hands of Indian consumers and households is going to be significantly higher this year compared to last year. Next slide. Now, obviously, this slide will be, you can play the videos if possible to play the video.
However, we as manufacturers and wholesalers have made alternate routes by increasing our marketing all throughout all the states in India, in UAE. We are doing it in UAE and Saudi, Qatar, and other markets also which we are looking at. The FTP which is happening between UK and Australia is affecting in a positive way the general industry, and we are hopeful that in the coming 3 to 6 months we will be able to nullify the effect of the US. But however, we are hopeful that good sense should prevail in India, especially in the US market, in the US, wherein Trump takes a decision again to roll back the tariffs from 50% to maybe 5% or 7%, which is absorbable by the Indian markets.
Do you think GST regulated have needed to install a new group for market?
Yes, we have already, when the 25% tariffs have come a few months back, and now 25% more is coming today, so of the 27th. We are looking on the lines that our marketing team goes to the markets also. When I say UAE is a good market for us, we say that UK now has become a good market for the Indian manufacturers. The Australia has become a good market for us. I feel the marketing, but the biggest market for us is automatically India itself, because there are so many people here, population and more than 6 lakh jewelers in the Indian markets. When India is already importing 800 tons of gold, largest exporters of diamond, we are looking more so to do with Indian markets also. Now, HNIs that strong people who are buying jewelry in India has increased substantially, and I feel we as manufacturers are looking also for not only outside India but inside India also to nullify the effect of the US exports. See, I think the effect should not increase from more than 3 to 6 months. I think we will be able to find different markets for the same, and we would be happy to get more people to going into each and every area and finding routes for exports. And I would request the manufacturers of the country that kindly do not offload your staff, offload your team, just be upbeat, manufacture good stuff. There are different markets for different designs, explore those designs and go ahead.
Okay, so we played this small clip from this interview by the President, Chairperson of the All India Gems and Jewelry Domestic Council, for the possibility with which they are looking at the current crisis as the tariff-related uncertainty as an opportunity to A, explore domestic markets, and B, also other markets which are now open to us on account of the various free trade agreements. Obviously, there is some uncertainty with respect to the duration of the period for which the additional tariff related to Russian crude oil purchase will last. But in general, the conversations are going on, and there is an expectation that we will see some kind of a resolution in the not so distant future, and therefore we do believe that our growth target for the current financial year, especially in the light of the strong showing by the economy in the first quarter, we will still retain the 6.3 to 6.8% range that we had outlined for the full financial year. At this point, of course, the downside is there in case the tariff impasse remains for a longer period. but we are hopeful that that will be resolved sooner rather than later. But this is also, as you all have been hearing in the last couple of weeks or so, we have also been using this situation as an opportunity to move forward, as the Honorable Prime Minister indicated in his Independence Day speech, to look at domestic reforms, deregulation, apart from the reduction in the indirect taxes and rationalization of the rates, simplification of procedures, etc. And also this is an opportunity for exporters to boost competitiveness of their products and look at explore other markets as well. So collectively, between the public and the private sector initiatives, we can turn this situation into one of long-term strength and opportunity. Next slide. So just to summarize, overall, what we are trying to show, apart from the first quarter numbers for the fiscal year, which is obviously backward looking, we also try to share with you the July numbers to give a sense of whether the economy is maintaining its momentum. Of course, these numbers are predate the tariff uncertainty that came up in the month of August. The second bullet point is that domestic demand, we believe, will strengthen on account of the higher purchasing power and also the onset of the festive season shopping from next week. And in terms of agriculture output, higher tonnage sowing supported by more normal rainfall, comfortable buffer stock and better output prospects will be there, and will also keep the food inflation benign, and non-food inflation also on account of the lower GST rates will also be giving further support to the overall low inflation scenario that we are seeing in the economy. And a couple of weeks ago, we also saw that the credit rating agency Standard & Poor's upgraded India to BBB, which is a well-deserved recognition of the macro and the fiscal performance, and we are quite confident that we will be able to maintain both, not only in the coming year but beyond, in terms of macro performance, in terms of growth and financial and fiscal stability as well. The near-term risks to economic activity, as I mentioned already, are definitely there in terms of exports and in terms of the second-order effects in terms of capital formation because of the uncertain outlook for external demand in India's largest export market. But we are hopeful that at this point, on account of the ongoing conversations, etc., that the situation will be short-lived rather than a longer duration uncertainty. Recent policy steps, this is the formation of the high-level committees on next generation reforms, forthcoming GST changes, and the ongoing deregulation activities at the state level. You must have been seeing various announcements by different state governments on removing restrictions on women working night shifts over time. The Uttar Pradesh government announcing very serious reforms on decriminalization in the coming months. The lower interest rates and liquidity measures taken by the central bank will reduce borrowing costs, will attract capital formation in the economy while boosting consumption and investment. To repeat, no revision is currently proposed to the growth forecast, and while we have noticed that the 10-year bond yield in the country has gone up a bit in the last month or so, from 6.2 to 6.6% at this moment, notwithstanding the credit rating upgrade, we are confident that once the market gets a sense of our continued commitment to fiscal prudence and fiscal stability while keeping up growth, then we do believe that the long-term bond yield will return to lower levels that we saw before the recent spike. With that, I conclude my presentation. I'm open to your questions. Thank you very much.